Hey investor friends, I'm Michelle Markey and today I'll share my latest observations with Alibaba, like how super investors are still buying Baba despite its Q3 2021 struggles and increasing live stream commerce competition and the potential for delisting risk. And if you appreciate this type of investing content, I'd love if you could please like and subscribe to my video and YouTube channel because as many of you know, I do my best to follow in the footsteps of some of the greatest of all time investors and my favorites, Warren Buffett and Charlie Munger. So throughout this year, I've been doing my best to increase my circle of competence in understanding the business of Alibaba. So each of your likes goes a very long way in helping promote my YouTube channel, and I greatly appreciate it. Thanks. It's my goal to give you my thoughts as objectively as possible and keep calm in spite of many negative news headlines surrounding Alibaba, like how Alibaba's share price plunged in the double digits following its mid-November Q3 2021 earnings results, and how its stock price has hit multi-year lows, and how China's economy is slowing down amid construction slowdown and a lot of real estate debt implosion, and how Mohnish Pabrai has sold 78% of his Alibaba holdings. And in spite of all that, I try to give you a holistic view on what I think is happening and how even though times are tough for Alibaba, there could also be a lot of upside. But as always, none of this is investing advice, and I highly encourage you to do your own work and to see if you want to invest in this type of company or maybe not. Maybe it's better off to not invest in Alibaba. So I hope this all helps you. I know we all can't help but look at the stock share price, and the last I checked, Alibaba seemed to be trading in the low 120 something dollar per share, and I kind of wouldn't be surprised if it ends up trading even in the 110 or 100 range per share. And it's almost like the Seeking Alpha article says, where it's always darkest before the dawn. But that article is from 2018, and back then Alibaba's share price was around the 140 to $150 range before bottoming out in December 2018 at $130 per share or so. And nowadays it looks like we're breaching those support levels to go way beyond below $130 per share and into this 120 per share range, which seems kind of surprising that Alibaba has not held support based on a technical level. But looking at some recent MACD histograms, it looks like it's getting less oversold, and based on stochastic measures, it looks vastly oversold. So it's bound to be heading on an uptrend at some point soon, maybe in December as Alibaba nears its December 16 and 17 Investor Day. But who knows, it could go up and down, and we'll see what happens. Even though Baba's stock price is off by more than a quarter from its almost $170 per share that it reached in mid-November 2021 before the earnings results came out, it's still among the top buys in the last 2 quarters in super investors that Data Roma keeps track of, where we saw that 8 super investors added or bought Alibaba compared to 6 super investors selling it. So considering all that, it's a little bit of a wash, but it still seems a little bit more bullish, where overwhelmingly more super investors added Baba shares than sold them. So that's a positive sign, according to if you follow what super investors are doing. While it seems like Charlie Munger and Greg Alexander continue to remain bullish about Baba's future, it's a little bit more puzzling that Charlie Munger disciple Mohnish Pabrai has actually significantly reduced his stake in Baba, reducing his $58.5 million position down to only $8.5 million. So he sold off about $50 million worth of Baba and reducing his portfolio size of it from almost 8% down to only 1% in Q3 2021, and that's based on him saying that he manages around $750 million of assets under management. So I'm going by that and not what it says on Ticker or Data Roma, because some of those are limited in what they can pull from online filings like the 13F filing or other kinds of filings. But in reality, I know that Mohnish is invested throughout the world, so I know that Alibaba is a way smaller position in his overall portfolio than maybe we've we've been led to believe if we only look at data Roma, let's say. But in general, some of the reasons why maybe Mohnish did this could be maybe he's being sneaky and just wants to convert a lot of what was his New York Stock Exchange listed BABA ADR shares into the Hong Kong Stock Exchange listed version of it. And even though it's still VIE structure, if he converted from the New York to Hong Kong exchange, that means that it's no longer reported on his 13F. So who knows, maybe he's still holding on to a majority of the shares, but just maybe seeking shelter in case BABA were to be delisted from the New York Stock Exchange. So that could be one potential reason. Or maybe Mohnish is really turning bearish on the future prospects of Alibaba and he doesn't believe in it as much, and maybe he's drawn to something like Tencent more as a spawner business, and maybe he just needed to free up some cash to invest in something like that. Or maybe he invested in Prosus or Naspers, which own a large stake in Tencent. Or maybe Mohnish is just doing some tax loss harvesting and then maybe he'll buy back later, and maybe he's even buying back now in Q4 2021, and we might not find out until up to 45 days after the end of the current quarter. So that might be not until mid-February 2022 by the time we might find out what Mohnish is really up to. And even then, we may never entirely quite know what Mohnish is doing. So we'll see what happens. Some of my takeaways from their September 2021 quarter results include how they've served globally 1.24 billion annual active consumers, and they're committed to their long-term target of serving over 2 billion global consumers, and they're on target to achieve 1 billion Chinese consumers served. And with Alibaba facing headwinds like Chinese regulatory pressure that some have called a crackdown on big tech, and also slower than expected domestic consumption growth, the management of Alibaba is focused on increasing investment in their growing businesses, but they're also reducing their revenue forecast. Like in May, they projected for fiscal 2022 that revenues would increase by 30%, but now that's been reduced to only 20 to 23%. And then in addition, Daniel Zhang, CEO of Alibaba, considers its $15.5 billion contribution to China's common prosperity to not be a donation, but rather be an investment. And he also considers that an ESG type of investment. So it's not as if Alibaba isn't still on a positive growth trajectory, but for now it seems like their growth is slowing down, and that's why Goldman Sachs still attributes them having more than a 60% upside, and how some YouTubers like Felix and Friends attribute at least 100% upside to Alibaba. So we'll see what shakes out with their stock price in the future. And looking at some of their financial fundamentals, they still had total revenues up by 29% year on year, and commerce revenues up by at least 30% across China and international commerce, and their cloud computing was up by 33%. And overall, I wanted to look at some of their cloud and free cash flow figures. So I looked at also how they performed back in 2019, because that was more of a normal year compared to 2020. So looking at how they did in 2021, it looks like the cloud income still was a loss of $312 million US, which is still better than how they'd been performing on a quarterly basis in the year leading up to March 2021, where they had a total income loss of $1.4 billion, but they're on a trajectory of improving so that their losses are less. And at the current pace, they could even have cloud revenues potentially lead to a break-even income from operations by March 2022's year end. But looking at some of their free cash flows, they haven't been performing as well as they had in the last couple of years. Like the current free cash flows of $3.5 billion is only better than how they had performed in the September 2018 quarter. So overall, their free cash flows are down, but their cloud revenues are up. So in some ways, Alibaba's revenues and income is on the mend, but still maybe not as good as it had been recently. With ride-sharing company Didi facing Chinese regulatory pressure to delist from U.S. exchanges, it appears that some are extrapolating this delisting risk situation and applying it to Alibaba, as you can read about all the fear, uncertainty, and doubt across at least 2 Seeking Alpha articles, and you can decide for yourself how likely the risk is for Alibaba to delist. And I also talk about what the possibilities could be in delisting for VIE ADR type entities in one of my other videos, so feel free to learn more about this potential risk, which is always real when it comes to owning Chinese companies, since foreign investors do not truly own the companies, but actually own a shell company in the Cayman Islands. But I think that some of these delisting risks are kind of a little bit overblown and maybe hyped up lately because Alibaba's share price has been tumbling. And some have the opinion that sometimes smaller companies could delist because investors want to take them private and make profits that way. And some have said that with Alibaba, that's unlikely for it to go private since it's too big. And just to quickly note, even if Alibaba is delisted from the New York Stock Exchange and people can convert their New York Stock Exchange ADR shares into Hong Kong shares, it's still a VIE structure, which means that foreign investors still do not have true ownership to the Chinese Alibaba company. So just keep this in mind, that there's still VIE risks involved nonetheless. In more exciting news, e-commerce has been on fire in China, where it's a marketplace of almost $3 trillion compared to the US, which is hovering around $850 billion in retail e-commerce. And it's been growing rapidly over the last 5 years across the whole world. And it's especially compelling in China, where a lot of key online leaders or social commerce influencers are inspiring a lot of young people to want to buy goods through watching a lot of live streaming shows about products that people could be interested in. And among these include Taobao Live's Via, who has been selling billions of dollars worth of products through Taobao Live. So it's really incredible how much e-commerce live streaming has taken hold in China and how much Alibaba is facing a lot of competition from others that I'll talk about. While Alibaba's Taobao and Tmall still seem to be holding their place at the top of live stream e-commerce, their competitors are nipping at their heels, and they include the likes of Kuaishou, or also known as Kwai, JD.com, Pinduoduo, Douyin, which is also known as TikTok, and also Xiaohongshu, which is also known as Little Red Book. And across all of these live streaming social commerce entities, there's a lot of shopping going on, so it's no wonder that Alibaba is facing the pressure. A Forbes article says that among the global e-commerce companies, 4 of them are Chinese, but in reality, Taobao and Tmall are owned by Alibaba, and that's 29% of the world's e-commerce market, followed by JD.com at 9% and Pinduoduo at 4%. But some are also saying that live streaming entities like Douyin, TikTok, and Kwai are gaining some more market share in the live stream commerce space. And the hundreds of millions of visits per month that these Chinese e-commerce apps have, as well as the sheer volume of their sales, is probably something even Amazon is envious of. And I found some cool stats online, like from the China Guy's blog, where I can see how many millions of daily average users some of these apps have. And I also learned about the Chinese city tier system in order to know how big of a reach some of these apps have across some smaller size cities. Overall, despite increasing competitive pressures and the headwinds that Alibaba is currently experiencing, I think that as long as they continue to focus on their 3 key pillars of domestic consumption, globalization, and cloud computing / data intelligence, that they'll do okay in the long run, especially if they live to 102 years, as founder Jack Ma projected Alibaba to have a company lifespan of 102 years, but only time will tell. And if you enjoyed this video or learned something, please like and subscribe, and let me know in the comments what you think about what's going on with Alibaba. I'd love to hear from you. Till next time.